After this, the techniques which are available, we have discussed, which are included in our syllabus. We have discussed payback period and the NPV, that is net present value. So today we'll take it up about internal rate of return and then understand. After that, we'll move to the next chapter, that is standard costing. So that's only, of course, the entire capital budgeting topic you will be studying in detail. Many adjustments you will learn, many aspects related to capital budgeting techniques. You will take it up at when you study FM paper. Okay, this is basic understanding about what these techniques are. So the techniques basically talk about whether the investment proposal should be made or not, or um, they just have to reject it because it's not profitable for them. Okay, so there are five techniques actually, but out of these five techniques, um, MA is talking only about this. Management accounting paper is talking about only three techniques. 1 second. Okay. So management accounting paper has only three techniques which are discussed. One is payback period, NPV, IRR. So we will take up. We've already done yesterday two techniques. Let's take up the third one, which is internal rate of return. I'll try to explain. Let's see how much you will be able to understand. I am not sure about that, but let's try to understand this. But technically, you just understand the meaning of it. We don't have to take up any question at this point of time because it would not be tested here. Um, See, yesterday we have worked out one question about NPV. NPV, it says that this particular question, it says the company's cost of capital is 8%. So at the rate of 8%, when the cash flows were discounted, then the present value of the cash flows was this much, and then we have proceeded further. So which means to say that, see, all the future cash flows do not have the same value as they are projected. See, like 23,350 as on today, if it is compared, it is worth only 21,620. 29,100, 2 years later, it is only, as on today, it is worth only 24,948. 27,800 is worth only 22,000 as on today. So what does it indicate? It indicates that the value of the cash flows um, have a discounted value as on today. That's the meaning of it. They have a discounted value as on today. So if that is the case, when we are discounting at 8%, we see that the present value of cash outflow and the present value of cash inflows, they both are not equal. 68,638 is the total of the present value of the cash inflows. Cash outflow is 60,000. So we see that they both are not equal. So to make it equal, maybe we have to try another rate, interest rate, some other interest rate instead of 8%. If we try it out at some other percentage, I think it will work out. So the concept of IRR talks about the concept of IRR says when the cash inflows are discounted at some rate, they both are equal, cash inflow and cash outflow. So let me scribble here only, on the screen only I will scribble. See, cash outflow is the investment amount. As on today 0 year, whatever is the investment which is made is cash outflow. So this should be equal to the cash inflows which are earned from first year until the last year, that is CN, cash flow in the nth year. But when they are discounted, the discounted thing is recorded as C1 by 1 plus K. K is the discount rate. K is the discount rate for the first year. Then we have C2, the next year C2 cash flow in the second year divided by 1 plus K whole to the power of 2. So it goes on like that. So if it is nth year, then we see that Cn by 1 plus K whole to the power of n. IRR says that at what rate if when the cash flows are discounted, the sum total of all the cash flows is equal to the cash outflow. The sum total of the cash inflows when discounted at a K percentage, the sum total of it should be equal to cash outflow. But see, we cannot very simply substitute, we cannot simplify this equation, take all these, keep K on one side and then take all the other variables to the other side. To solve that is not such a simple task. Why? Because there is an exponential. To solve that and bring it out is not an easy task. Because it is not an easy task, what do? Is we keep on trying with different rates until we get that the sum total of it should be equal to the cash investment. So it is basically a trial and error method which is adopted to find out what is IRR, internal rate of return. So let's take up one question from the examination kit which talks about IRR. One second. $317 is the question for IRR. Let's take it up. An education authority is considering the implementation of a CCTV closed circuit television security system in one of its schools. Details of the proposed project are as follows. Life of the project is 5 years. Initial cost is 75,000. We have annual savings, that is labor cost and other costs, 20,000, 5,000. NPV at 15% is 8,800. What is the internal rate of return for this project? Already at 15% when they have discounted the cash flows, the NPV is a positive value 8,800. So we need to bring it down so that the cash inflows and cash outflows are equal. So which means that NPV should be 0. Cash inflows minus cash outflows, it should be 0. So that's the concept here. So if that is the case, because NPV at 15%, when they are discounted at 15%, the value has already come down, is at 8,800. We have to bring it down. When we have to bring it down, so we have to increase the discount rate. Instead of 15%, maybe we have to select a percentage which is higher than this. Even 7 on the screen. So the life is 5 years, initial cost is 75,000. Then we see the life of the project is 5 years. After that, we have initial cost. Initial cost is 75,000. So see, the question has annual savings here. They were able to save some cost. So whatever is the savings, that becomes their benefit. They were able to save these costs, so that's their benefit, or that's their cash inflow. So that's the benefit. Now benefit is how much? 20,000 plus 5,000, 25,000. That's the benefit. Is it different in each of the years? See, the previous question, we see that the cash flows are different in each year. But here we see that all 1 to 5 years, every year it is the same. So if we are calculating NPV at 8,800. Now here is 0. Then we have cash flows. The first one is an outflow, which is minus 75,000. Then from year 1 to year 5, all of them it's the same thing. When it is the same thing, one to 5 years, when it is the same thing, we call that to be as annuity. What is the cash flow? Labor is 20,000, other cost is 5,000. So altogether it is 25,000 labor cost, the total savings. So total savings is 25,000. See, the previous question, we have worked out on depreciation. Should we work out on depreciation? See, in the yesterday's question, when we worked out NPV, what did we do? We have started not this one. Payback period. See, these are profits which are mentioned. Profits are given. So profit is after deducting the depreciation. So what one additional step we had, that is we have added back depreciation. Profit is calculated as sales minus cash expenses minus depreciation. So what did we do to find out what are cash flows? We have added back depreciation to the profit. But here we don't have to take it up depreciation at all. Why? Because there is no amount of depreciation deducted. All what we have from this particular question is how much savings did they make, and the savings are considered to be as cash flows. That's it. So now don't make a mistake of calculating depreciation and adding it back. What are the details which are given in the question have to be noted down. So what do we see here? We see that the annual savings are 20,000 plus 5,000, 25,000. So now in this case, how do we work out? See, each of the years we have taken the discounted value, like here the discounted value at 8% and the present value of $1. So we have taken, and then these are the rates. Now we have to select the annuity table. There are basically four different types of tables in financial management which we have to look into. Two tables are to calculate present value. Two tables are for future value. So when we are trying to calculate the future value of cash flows, at that time we depend on future value techniques. But here we are finding out, 1 second, I'll put it on the internet. So when I'll erase the screen here so that it becomes easy for us to work it out. We see the cash flows are 25,000 for all the years 1 to 5 years. So this situation is called as annuity. When it is annuity, we select present value annuity factor at. See, when at 15% they got a positive value, now we have to bring it down. We have to make it equal to 0. So what do? Is we increase the discount rate. We discount it more. Higher amount of discount should be there. So when that is taken, 20%. Let's assume it's a trial and error method. There is no rule. If we still do not get it by 20%, we further increase it. So that's how we have to proceed further. Now I'll put to see this one. You see this, the present value of an ordinary annuity of $1. So these are annuity values. Since we are selecting 20%, I just selected some site on the internet. So 20%, you just see that the values are, we want it the value to be for the 5th year. When every year it is the same thing, we don't take individually each year and multiply, but take for 5 years. This is 5th year for 5 years period at 20%. This is 5 years at 20% here. So the value is 2.99061. So the present value factor is 2. Then find out what is present value of cash flows. So now this time we got a negative value. Do you see that? NPV is a negative value. So when it is a negative value, one is a positive value, one is a negative value. But we want exactly 0. So then what do? We from here, instead of trying out another percentage, because the percentage could be in decimal values also. So for that reason, what do? We take up a interpolation formula and then work it out. So what is the interpolation formula? So one value is above 0, one value is below 0. At 15% when cash flows are discounted, we have 8,000 plus 8,800. So one value is above 0. Another value 234 at 20% discount rate is minus 234, which is below 0. So we take up the interpolation calculation based on this formula, whatever is the formula. So the formula indicates that L is the, between two rates. We have worked out two rates. One is 15%, one is 20%. So between these two rates, the lower rate should be taken up. So L is equal to lower rate plus NL is net NPV at lower rate. NPV at lower rate is 8,800. Lower rate is 15%, so we got it as 8,800. Divided by NL is NPV at the lower rate, NH is NPV at the higher rate. So we basically find out the difference between these two NPVs. After that, into the difference between the rates H and N. Okay, so IRR is equal to L plus the numerator is NL divided by the denominator has NL minus NH into H minus L. Then let's substitute all the values in the equation. IRR is equal to we see lower rate is 15%, 15% plus, then open a square bracket. Within the square bracket, there is a numerator which is NL is NPV at the lower rate is 8,800 divided by, in the denominator we see the difference between the, this is 8,800 minus 234.75 divided by into H is 20% minus 15%. We got it as 19.87%. IRR is equal to 19.87%. That's how we calculate IRR. Annuities is when every year it's the same cash flow, we call that to be as annuity. When these are different cash flows, we just call uneven cash flows. If they are even cash flows every year, we call that as annuity. But otherwise, different cash flows are there, uneven cash flows. Perpetuity is, yesterday also I mentioned that if forever it would be the same cash flow, we call that to be as perpetuity. An annuity is a constant annual cash flow for a number of years. The formula is whatever is the 1 minus 1 plus r whole to the power of n divided by r. If the cash flow should be divided by r, otherwise it should be 1 by 1 plus k whole to the power of n. When I was explaining to you how discounting factor is recorded, but in case of perpetuity, the cash flow would be divided by r. Just remember that. There's a lot to be practiced. Now that's your responsibility. I have helped you out to understand what are the techniques and how do we take up the calculation. One class, everything learning about the capital budgeting is a task in itself, but the real work of learning will be done by you people when you practice the questions. Please take up this work and then practice questions. And also, I think when you are doing the content in your college program, at that time also you get time to practice. Please take it up. Take up the practice. Now we see whoever. Let me later on. You don't feel bad. let me tell you that whoever scribbles on this screen, the name gets displayed. Okay. So this time it is from who has scribbled this is, I'm not revealing the name, but this is from St. Joseph Trichy College. Next time you scribble it, I will read out your name also. Done? The next chapter, what we have is standard cost. What is a standard cost? A standard cost is the planned unit cost of a product or service. But that again is the same thing what we have understood for budget also. Budget also, we understood the meaning to be something like that. That is a planned figure for the future. What has to be implemented when it is accounted, that is also budget. Now here, what is it? A standard cost is the planned unit cost, planned cost per unit cost of a product or service. It is an indication of what a unit of product or service should cost. Standard cost represents target. So there is a set amount which is decided, and that is taken to be as the standard. Then standard cost represent target cost, and they are therefore useful for planning, control, and motivation. They are also commonly used to simplify inventory valuation. In case of budgets, we have learned budgets to be as prepared for operating purposes, operating budgets, then financial budgets. Those are the budgets which were prepared. Under standard costing, the standards are decided for the revenue and cost. Revenue, what should be the standard sales, what should be the standard number of units, and the standard selling price. In case of cost, what would be the standard cost for elements? What are the elements? Material. What should be the standard cost for material? Standard cost for labor. Standard cost for overheads. Fine. Those are the things which have to be taken into consideration. What are the types of standards? See here, I'll come back to that slide. What are the types of standard? I'll talk about that. But briefly, let's look into this one. The first category of standards are about the sales, about the revenue. So that is sales variances. Okay. Then we have material variances, labor variances, overhead variances. Overheads are again understood as variable overheads and fixed overheads. So these are the cost variances which are prepared. Done. But first, when standards are decided, what are standards? Standards are something set as a target or something which is decided to be a benchmark which the organization has to achieve. So that's the standard cost. So when standards are decided, they have to reach that particular target level. That's standard cost. They can, in case of cost, they can spend as much as standard cost or less than standard cost. But if they spend more amount, that is overspending. So they are not allowed to spend more than whatever is the standard cost. If they spend more than that, it is considered to be as an adverse or unfavorable variance. Variance is a deviation from whatever is the standard. The revenue aspect of it is also similar to that. But revenue, the minimum revenue which has to be generated is the standard revenue. They should put in an effort to achieve more than the standard. In case of cost, they should incur less than the standard. That point we have to remember. When standards are decided, when standards are set up, when standards are decided, these are the types of standards which are usually considered. First one is ideal. Assuming that ideal, the best situation would prevail, the best possible conditions prevail, and they decide to be as ideal standards. So no unfavorable event would happen is the assumption. everything would go on perfectly well. So in such situation, what should be the standard is decided as ideal standards. Okay. Then we see that um, what is attainable? What does it mean by attainable? See, ideal situation prevailing all the time is not a possibility. It would not prevail all the time. So why? Because there may be some amount of loss happening, normal loss. We've discussed about normal loss, or there may be a machine breakdown, or workers may not be present. There might be absenteeism. See, there are various issues wherein the best scenario does not prevail all the time. So having some relaxation for that and deciding a standard which is practically possible for them to achieve that attainability. Okay, such a target is set. We call it as attainable targets or attainable standards. What would be expected under normal operating conditions? So, normal operating conditions, we see that so many disturbances happen in case of, in terms of material may not be available, labor may not be present there, machine breakdown can be there. Um, okay, demand may fluctuate, things like that. So, attainable standards. Then the next one, basic standards, a standard left unchanged from period to period. So it's the same thing. Once it is decided every period, it is the same. But every year the scenario changes because there are so many things which change in the market, in the industry. Then in that case, that the one initially which is prepared as a standard may not be suitable, applicable for the changed scenario. But instead of making adjustments, incremental changes, when it is unchanged from period to period, that's called as a basic standard. Current one, a standard adjusted for specific issues relating to the current period is a standard because they have foreseen, they have anticipated certain changes to happen. Therefore, when the standard is adjusted, we call that to be as current standard. So, first category of variances are revenue variances or sales variances. So, what are sales variances? The under sales variances, we have sales volume variance, sales price variance. So, these two variances are there, sales volume variance. Volume is the number of units which are sold. That is the activity level. So, sales volume variance is calculated as budgeted sales. That is the number of units, budgeted sales units. These are the units which are sold in minus the actual sales. See, budgeted sales into the uh, standard selling price per unit. So, at what selling price if they sell? That is budgeted units into they have fixed on the selling price. So selling price per unit, that is budgeted selling price per unit. These are the say this would be the sales value at the budgeted units. This has to be compared with when actual units are sold, actual units into budgeted selling price per unit. Because price is fixed, they are only talking about it is volume. Only the volume part of it, they're trying to find out the difference. So this is budgeted. Here also it is budgeted selling price per unit. Budgeted selling price per unit. Actual units into budgeted selling price per unit. So the difference between budgeted units into budgeted selling price per unit minus actual units into budgeted selling price per unit. Okay, so that is the um, the sales part of it. But There are again two different things which are mentioned. One about marginal costing, another one is absorption costing. Do you remember what's the difference, the point of difference under marginal costing and absorption costing? The difference was how the ending inventory was valued. At the time of valuing ending inventory, under absorption costing, no distinction was made. So, the total amount of cost proportionately was charged. But in case of marginal costing, only the variable manufacturing cost was charged to the closing inventory. So, marginal costing depends on an equation called as sales minus variable cost is called as contribution. So from contribution, the fixed cost is also deducted and then that is called as the profit. In case of marginal costing, the dependence is on contribution per unit. In case of absorption costing, the dependence is on profit per unit. So the volume variance is basically, even if we have the selling price per unit minus variable cost minus fixed cost, when we deduct, we either come to contribution per unit or profit per unit. So the sales volume variance under marginal costing is the difference between the units, budgeted units, actual units into contribution, this one, standard contribution per unit. But in case of absorption costing, the difference between units into standard profit per unit. Please make a note of this one. Then the price variance. So it is about the difference in the price, the budgeted selling price, the actual selling price applicable at the actual quantity sold. Then the first one is direct material variance. So material variance, that's the cost variance. I'll give you a little easier way to remember. So I'll just put you through. The first one for material, we first find out what is the cost variance. Material cost variance is standard cost of material minus actual cost of material. The standard cost of material can be calculated as standard units, standard quantity into standard price. Minus, we have it as actual units or actual quantity into actual price. Cost is basically a component of two different things. It has two different components. It's basically made up of two components. One is the quantity and the other one is price. So quantity, price. So this material cost variance can be further classified as price variance. So material price variance or material quantity variance. We also call it as material usage variance. The quantity which is used, usage variance. So price variance is the difference between standard price minus actual price applicable at the actual quantity. Here, it is the difference between the standard quantity minus the actual quantity applicable at the standard price. Just remember this one. No matter how the explanation is given, we just understand that um, the cost variance is the difference between the standard cost minus the actual cost. Cost variance can be split into price variance and usage variance. Price variance is the difference between the price applicable at the actual quantity. Usage variance is the difference between the quantities applicable at the standard price. Similarly, we can also calculate what is labor cost variance. Labor cost variance, it is in case of quantity, we would not have quantity. So it is standard time. Standard time into standard price or standard rate or whatever we call that as. So this is standard price or standard rate minus actual time or actual hours into actual price. In place of material price variance, we write it as labor price variance. So in case of actual time, it would be actual quantity, it would be actual time and into standard price minus actual price. Now there is no labor usage, but the term is called as labor. The logic is the same. It is labor efficiency variance. What is efficiency variance? How much time did they was set and how much time was used? So how efficient are they in terms of using the time? So that's efficiency variance. Usage variance is further divided into mixed variance and yield variance. That is not a part of MA syllabus. That's a part of PM syllabus. So when you come to PM, at that time you will understand what are mixed variance and usage variance. No matter how it is given, this is the logic. The same is the logic even for variable overhead variances. So here it talks about the direct material variances. We have the total variance is divided into price variance and usage variance. Total variance is the difference between the standard cost of material minus the actual cost of material. Here we have the actual quantity into actual price minus actual quantity into standard price. Here actual quantity into standard price minus standard quantity because usage no standard quantity into standard price. So the explanation here it's not very clear to understand, but the chart which I put it, you can copy those formulas. So here in case of labor also it's the same thing. Total variance is divided into rate variance and efficiency variance. The same is the logic even for variable overhead. Total variance, in case of price variance, we are calling it as expenditure variance and efficiency variance. Fixed overhead variances are what is marginal and marginal costing and the absorption costing techniques. See, we know that the fixed overhead variances, overhead costs are also charged to the ending inventory under absorption costing, but under marginal costing, fixed overhead costs are not charged. So actual expenditure minus budgeted expenditure into the fixed overhead expenditure. When we are finding out the difference between these two, the actual expenditure minus the budgeted expenditure, that's overhead expenditure variance. Then the other variances are also there. Under fixed overhead variances, we see if it is absorption costing, volume variance is classified as efficiency variance and capacity variance. Then let's start with the numerical questions from the examination kit and then understand each type of variance. So question number 345. One second. Are both the CRs there in the class? CRs. I think one CR is Joshua. Other CR is Priya, if I'm not wrong. I do not know. I'm really sorry.
Yes, ma'am.
Yeah. Um, can you please send me the attendance today after the class? Not only for today, all the days, since you have the
Okay,
record.
ma'am.
Okay. And for Garden City, is it Priya? If I'm
Yes, ma'am.
so, please you also you have my number, no?
Yes, ma'am. I'll send you.
Thank you. Thank you. Okay. So let's do question number 345. A company uses standard marginal costing. Last month, the standard contribution and actual sales was 10,000 and the following variances arose. Total variable cost variance is 2,000 adverse. Sales price variance is 500 favorable. Sales volume contribution variance is 1,000 adverse. What was the actual contribution for last month? Sales minus variable cost is equal to contribution, isn't it? The sales price variance is 500, volume variance is 1,000 adverse, then variable cost variance is 2,000 adverse. The first line says that last month the standard contribution and actual sales was 10,000. Okay, so the standard contribution and actual sales is 10,000, but now there are certain variances which took place. That is the price variance. We see that price variance is 500. Then we also have the volume variance, but volume is not doesn't fit into this part of it. Okay, we just find out the difference between selling price minus variable cost is contribution. So what is applicable is, what two things are applicable is, only these two things should be taken into consideration, not the volume. So let's start with the sales price variance is favorable. So add sales price variance 500. Then we see that the variable cost variance is adverse. How much? 2,000. So let's variable cost variance minus 2,000. So after these adjustments are made, so the actual contribution is 8,500. These are adjustments. Let's work out the variance questions. Select another question where we get a chance to apply the formula, not finding out the adjustments. This is question number 347. We are asked to calculate what were the labor rate and efficiency variance. So let's start with first one, labor rate variance. The formula is the difference between standard rate and actual rate applied at for the actual time. What information do we have? See, the question says the following information relates to labor cost for the past month. Budget, budget or standard is given as labor rate is $10 per hour. The time is 50,000 hours. Time per unit is 3 hours. Production units are 5,000 units. Then actual details are given as wages. Total wages paid are 176,000. Then production is 5,500 units. Total hours worked is 14,000 hours. First, let's write the formula. Labor rate variance is equal to actual time into the standard labor rate minus the actual labor rate. So we need to have three variables. What's actual time? Total hours worked are 14,000. Actual total hours worked are 14,000. Now we need to know what is standard rate. What's standard rate? Actual rate. Actual rate is not given. Wages paid are 176,000. Production is 5,500 units. And total hours worked are 14,000. So those details only are given to us, but actual rate is not given. Can we find out? Can we find out what is actual rate? Yes, we can find out. We can find out what is actual rate. How do we find out what is actual rate? $176,000 divided by 14,000 gives us the actual rate. Labor rate variance is equal to we don't write a negative sign, we just find out the difference and then mention whether it is favorable or unfavorable. We got it as 36,000. What do we see here? The standard rate is only 10, but the actual rate is 12.57. That's quite high. That's above, see, the rate should be 10, but when they paid at the rate of 12.57. So the actuals were, in terms of cost variances, the actual should be less than standard. But here we see that the actual is more than the standard. So whenever it is more than standard, this becomes an adverse variance. Then the next one, we are also asked to calculate what is labor efficiency variance. The formula for efficiency variance is equal to standard rate into standard hours or standard time. Standard time minus actual time. Okay. So we need to know three items, three variables. What is standard rate? Standard rate we already know, which is 10. Standard time, then we need to know what is actual time. Actual time is 14,000 hours. This is 15,000 hours. No, the units are different. I'll come back to this one. Actual time is 14,000 hours. One important point what we have to observe here is the production units are given for 5,000 units under standard, but they actually have spent or produced 5,500 units. So when 5,500 units are produced, so that the time which will be required also will change. The time which is required also will change. Now we are asked to find out what is standard time. Standard time, the standard time of 15,000 is given when the output is 5,000. But is the output 5,000 in under actual? No. So actual output was 5,500. They are not comparable. Like yes, one of the days I mentioned that the first year student performance and second year student performance cannot be compared. So the details at 5,000 units and the details at 5,500 units are not comparable. So what do? We adjust the standard. That is the flexible budgeting. When we adjust the standard time which is required for making 5,500 units. So here it will be for every unit it takes 3 hours is equal to 3 into 5,500 units. So it says I'm writing it here for your reference 3 into 5,500. This is called as standard time for actual output. Now just substitute everything. Labor efficiency variance is equal to it's 25,000. Now is it favorable or adverse is what we have to understand. So favorable or adverse, when we look into that, standard time is 16,500. But how much did they take? They took only 14,000. So this is a favorable one. Favorable variance. So the option will be C. C is the answer is C. Just a minute. So let's take up the next question. The one question for material variances also we will try. The question says the following information relates to the next two questions. The standard direct material cost for a product is 50 per unit. That is 12.5 kgs at $4 per kg. Last month, the actual amount paid for 45,600 kgs of material purchased and used was 173,280. And the direct material usage variance was 15,200 adverse. What was the direct material price variance last month? What was the actual production last month? There are details given as the standard direct material cost for a product is 50 per unit. That is the price. The price is given per unit. It is $50. Last month, the actual amount paid for was 45,600 kgs of material purchased and used was 173,280. The usage variance is already calculated and it is 15,200 adverse. So now in this situation, the first one we are asked to find out what is the price variance. The second one is about what is the usage. So what is the actual, what was the actual production last month? But first let's start with 363, question number 363. Material price variance is equal to so do we have these three variables? What is actual quantity, the standard rate, and the actual rate? These are the three different things what we have. The rate per kg, that is $4 per kg, the material which is purchased. The actual material details are not given. We do not see, we only see that the last month the actual amount paid for 45,600 kgs was 173,280. So here actual quantity is 45,600 kgs, 45,600 kgs of material. Then actual rate is equal to 173,280 divided by 45,600. Find out what is material price variance. $9,120 favorable. $364. what was the actual production last month? See, that is related to usage variance. Material usage variance is equal to standard rate into standard quantity minus actual quantity. That's the formula. And the variance is already calculated, and the variance is given as 15,200 adverse. 15,200 adverse. So now we are asked to find out what's the actual quantity. What was the actual production last month? So how many units did they produce that they have a material usage variance of 15,200 adverse. So that is what has to be calculated. Usage variance is equal to the difference between the standard quantity of material and the actual quantity of material. So actual quantity of material which is used, we see that they have used 45,600 kgs of material. So when they have used this quantity of material, see, I've removed few students. Now they are Sanjeev Nirmal, Jairam Gandhi, Haribhaskar, Amudala Krishnan, and Haribhaskar. Okay, let's not get deviated. Standard rate is 4. Now we need to know what is standard quantity. Standard quantity is for how many uh, actual units which are produced. Then we also need to know what is the actual quantity of material which is used. So actual quantity of material which is used is, we see that they have used 45,600 kgs of material. 45,600 kgs of material was used. Standard quantity. SCBC standard rate into standard quantity minus actual quantity. We do not know what are these details, is equal to, we have 15,200. But standard rate is what we know. So standard quantity minus actual quantity is equal to 15,200 divided by 4. Check that, how much is it? 3,800. The difference between these two is 3,800. Standard quantity minus actual quantity. Standard quantity is standard quantity will be the quantity required for the actual production into standard quantity. Actual quantity is equal to actual production into actual quantity. Actual material. So this is 45,600. If actual production is taken, it's into standard quantity.